is there any downside to massively overfunding a whole life policy? Because you happen to get paid less doing that. And it's when we just look at the math, it's hard for us to justify not max funding using like front loads and stuff. So it's like, what's your thoughts there? Because we've also been called out by many people by saying we're trying to undermine our colleagues and stuff by just pointing out the importance of overfunding, because you could take a Penn Mutual policy or Lafayette policy or One America policy, and how you structure that could be a huge difference from a standpoint of performance in the short term and long term.
I have whole life policies with my kids, and I'm in the process of buying one right now. And I did exactly the design you did. Low base, big term, big PUA component. It's a great product. Gives me a ton of flexibility. Gives me great economics. I mean, it's awesome. Not every company is designed to do that. I mean, to your point, like there are some companies that facilitate that better than others. There are some companies where all base contracts can be really attractive. I think about Mass Mutual's 10-pay. That's a killer accumulation product. It's less flexible, right? But it's tuned to do that, and it does it really well. New York Life, same deal, right? There are products that do certain things very well, but in terms of an overall package, yeah, I love that design. Here's the downside. The downside is when I think back to the 1990s when term blends were kind of just getting big, and there were a lot of agents out there who they would term blend not to overfund, but to underfund. And so there's a legacy of products out there where they say, oh, you don't want to pay $25,000 for an all base whole life? That's fine. I'll do, a minimal blend or a minimum base and a maximum term blend. And now your premium isn't $25,000, it's $10,000. Yeah. That's now what have you done? You've put risk onto the client and sensitivity to the dividend. But to your point, if you're overfunding it, it's like the opposite is true. You're actually putting less weight on it. You're actually doing the right thing, which is packing as much money as possible into it. So I love that design. I think it's one of the knocks on whole life is, whole life isn't flexible. Whole life is 95% as flexible as a universal life. The only way it's different is it doesn't say flexible premium, right? But it is a flexible price, way more flexible than people think. And I think the way you're using it is maximizing that flexibility benefit to the advantage of the client. Kudos to you guys for doing it.
Well, thank you. Appreciate that. I want to add on to the question that Caleb asked, because currently in the space, Infinite Banking, they have a seminar that they do once a year. It's like this think tank where they all come together and they talk about IBC and how it should be sold and the way they should structure their policies. And they're pretty big on designing it a specific way, which is essentially making the base and PUA almost equal to each other. So it's not really like fully overfunding it in a way that potentially like we would design it. And so one of the people in the space that was on stage, and I listened to another podcast, I kind of had this story. I wasn't like there by any means, was on stage and talking about the dangers of making the base too small. And essentially he was talking about, with the rising interest rate environment, essentially that can cause the policy to mech to some degree or another, with like the dividend going to PUAs and like causing a mech from a status. Is that possible? Is that just what they're just saying hearsay so that they can actually push the agenda more so? Or like, what is your thoughts around that?
Is it possible? Or there's some really weird stuff in the necessary premium test. I guess that's what he's talking about. It might be possible, but that's sort of like saying, "Hey, man, you should stay inside today because I hear an asteroid's coming to hit the Earth." Man, I'm not concerned about it. I would, and by the way, like carriers don't let you just mech contracts. Yeah. If you send a premium in and it mechs it, they send you back the amount and say, "Hey, did you mean to mech this?" So I don't. Again, I have an 8-year-old son who's worried about all kinds of stuff. And I'm just like, yeah, it is possible. It is possible that someone breaks into our house tonight. It is not probable. No one in the neighborhood's been broken into in 20 years. I don't know. Like, you can worry about that if you want to, but I'm going to choose not to do that.